Budget 2022 is basically a growth-oriented budget and a forward-looking budget. The projected GDP of 9.2, I think it's the highest in the world. So basically, budget 2022 laid down foundation for next 25 years. And I'm sure India will be a superpower in the world by 2050. So, and there are various amendments and initiatives announced in this budget, which we will discuss today. All this will definitely benefit retail in the long term. The announcement of Ease of Doing Business 2.0 is a welcome step. And you know, DPIIT has been working on a national policy for retail trade to enable ease of doing business in retail. And this will be a landmark reform for retail business in India. Though we did expect some kind of sort of relief for individual income taxpayer to increase consumption, which is missing in this budget. But the good news is that there is no additional surprise taxes have been imposed by the government. So it is our privilege. We have expert team from EY with us. I welcome Paresh, Parak, Sarika ji, Chinmay ji, and everyone, entire EY team who took out their valuable time and join us in this conference. Thank you so much, Paresh bhai, for accepting our invitation and joining for this program. Without any further delay, I would like to start the program, and we would be more than happy to have your suggestion, your question at the end of the program. So thank you very much. And I request Palak to start program with a formal round of introduction of our speakers. Over to you, Palak.
Thank you, sir. A very warm welcome to one and all. We welcome you all to the webinar on the impact of budget on retail and the recent GST amendments. Without any further delay, let me introduce the speakers for the day. And before that, I'll give you a brief introduction about RAI for those who are not aware of what RAI is all about. So RAI is the unified voice of Indian retailers, and we work with all the stakeholders, especially the government, for creating the right environment for retailers across the country. So it's a body that encourages, facilitates, develops, and supports the retailers to become modern and adopt the best practices that will delight the consumers. So we have around 14,000 plus members, which represent 500,000 retail stores. And without any further delay, let me introduce the speakers for the day. Can we have the speaker slide, please, Mr. Sanke? For the first speaker for the session would be Mr. Paresh Parekh. He is a partner at EY, and he is also a national tax leader for the consumer and the retail sector. He's a chartered accountant by profession and a commerce graduate from the Mumbai University. His focus area is consumer and the retail sector, and he has more than 25 years of experience. Along with him, a very warm welcome to Mr. Chinmay. He is ex-Niti Aayog, and he's an economist. He is in the Policy and Economy Advisory team at EY. He has been a part of Niti Aayog and looking at different aspects of the economy. A very warm welcome to you, sir. The third speaker for the day is Mr. Rahul Kakar. He is the director at EY, and he is also a commerce graduate from the Mumbai University. He's a chartered accountant by profession, and he's into EY direct tax practice. His focus area is again consumer and the retail sector. He has more than 16 years of experience. A very warm welcome to you, sir. Next speaker is Ms. Sarika Goyal. She's a partner at EY in the indirect tax practice domain. She's also a chartered accountant by profession and a commerce graduate from Delhi University. Her area of focus is consumer and the retail sector, and she has more than 20 years of experience. Finally, we have Mr. Sanket Desai. He is a director with EY in the indirect tax practice domain. He's also a chartered accountant by profession and a commerce graduate from Mumbai University. He has more than 16 years of experience and his focus area is on the consumer and retail sector. A very warm welcome to the expert team at EY. Thank you for giving us your precious time and being with us, educating our members. We'll be having the question and answer session towards the end of the presentations. We already have shared the audience questions with the speakers. Over to you, Mr. Paresh, for opening remarks. Thank you, everyone.
Thank you, Gautamji. Thank you, Palakji. Thank you, RAI. And as Gautamji said, this is growth oriented, but questions do remain. Is there enough push to consumption? If it is addressing only the supply side of the economy for pushing growth, by when we will see the results? Will it take more than 6 months? Because as of today, the demand is needing some push. The malls need support and there are challenges. So some of those immediate demand pushing factors have not been addressed by the budget. But as Gautamji said, it is a very bold and capital intensive and capex heavy budget. To really understand the nitty-gritties, I am requesting Chinmay to take a straight deep dive into some of the macroeconomic factors for next 10 minutes, followed by some of the budget provisions, which will be taken by Rahul Kakar and Sarika and Sanket. So Chinmay, all over to you to take us, all of us, through the nitty-gritties of the economic situation and how it will potentially impact consumption in medium and short term, and whether there will be inflationary pressures. This is one question everyone is concerned about as well. So Chinmay, over to you.
Thank you, Mr. Paresh. Good evening to everyone. It is a great honor to come and present our thoughts to you. So without wasting any time, I'll just dive straight into the budget and what is the economic implications of the budget and what we think is the...
Chinmay, sorry, just wanted to confirm if everybody is able to see the screen before we start. So...
yes, both.
Palak, if you can just confirm if we are able to...
Both voice and message is visible.
Yeah, it's visible.
Yeah.
Okay, perfect. Chinmay, please go ahead.
Yes, sure. So what I'd like to do is to spend a lot of time on the consumption side, on what are the positives and negatives going forward. But just before that, this is one generic summary, if we want to call it, of what the government is trying to do for the budget. The finance minister started with the suggestion that the budget is essentially looking at a 25-year horizon, and which set the tone for the fact that most of the budget announcements and most of the thought process is long-term in nature. And as already it has been said that this government has again focused on the supply side, and this has been there for several budgets now, that this is a supply side kind of a government which looks at a long-term picture, and they have again not focused too much on the near-term demand stimulus part. There are certain things which indirectly will help, which I'll get into. But just in terms of some of the summary announcements, obviously the infrastructure focus being there is a good thing for the economy in general. There is a lot of focus on the digital economy part, again by the government. And one important point I'd like to highlight, which may not necessarily be important for this year, but perhaps in next 5 years or 10 years, this is something that all the retailers will have to watch out for, is the digital currency announcement by the RBI. Just at a very brief level, if I explain, at the moment, a lot of economies globally are considering this idea. The idea is that many of us must have heard about cryptocurrencies, Bitcoin, and things like that. The idea is that similar to those, using blockchain technology, the government comes out with its own official digital currency, which is essentially a replacement for cash. Now, I am not claiming that once this digital currency comes, cash will go away. Certainly not, because we know that the entire country is not at the moment tech savvy, and digital connectivity is not there. But having said that, over time, with the launch of the digital currency, it is possible that more and more transactions take place through digital channel, and the importance of cash becomes slightly lower. So, but again, this is something that the government is going to start this year, and it will take some time. Secondly, there is a big pivot towards climate change and clean energy transition. That was again expected because the Prime Minister had announced that India will take up by 2070 a net zero target. So the government is going to come out with more and more such policies towards clean energy. So it is again something for everybody, including like retailers as well, to consider how to move forward in terms of greening, whether, for example, for malls to consider green certifications, to look at net zero pathways and things like that. And certainly going forward, government should come out with more and more policies in this regard. For example, in this year, they have said that for the commercial buildings, they're going to start an awareness kind of program on how to go about reducing their energy footprint. Finally, the third point, which is slightly relevant, is that urban infrastructure, there's a lot of focus this year. So over time, the governments are going to work with state governments, and they are going to put in some money with the states to improve and plan better their urban infrastructure. So that is something that one hopes will sort of take some effect again going forward in long term. So next slide, please. This was broadly the summary of what the budget was trying to do. Now, what is there in terms of the consumption side? So this is an interesting sort of picture. Now, there is a mixed story that one can see here. What we have shown you in the graph is the September to November 21 versus 2019. So, the last year, if you compare it with the last year, where obviously there was a lot of COVID impact, then one will not get the right picture because of the base being different. So what we've shown is the growth in some of the key consumption sectors. And what you see is that consumer non-durable sectors are still doing better than the consumer durable sectors. That's point number one. Point number two is that if we just focus firstly on the consumer non-durables, the growth rate at non-durable level is 5% in the last September to November period, which again is lower than what the growth rate was pre-COVID. So the demand has not fully recovered in non-durable sectors also. Again, some of the segments which are doing well are pharmaceuticals, for example. Food products has started to recover a bit, but beverages, leather, apparel, some of these are still quite weak in terms of overall activity. And one reason there is the K-shaped recovery that we have seen, that at least the low-income households, rural households, the informal sectors, the consumption items for them, the demand has been relatively weak because they have been affected more from the COVID-related shocks. And we see this again in the consumer confidence surveys, for example, that are there in the economy, that the consumer confidence is not yet back completely. But the idea is that once I think the COVID waves sort of start ebbing, the consumer confidence should recover very quickly. And again, for the non-durables part, we expect that the growth rate should pick up somewhat. On the consumer durables part, the growth rate is certainly still negative. And partly it is demand related, partly it's also supply related, because electronics and automobile segments have been affected by the global chip shortages. So that's again a concern. But having said that, as I've already mentioned, that the budget did not have any direct measures to boost consumption in the short run. So what do we expect going forward for this year? Now, I think coming to the positive sides, one, that the point I mentioned just before, that the supply constraints hopefully should ease on the global chip shortages. There are a lot of investment that are taking place in US. India has also started now looking at it, and Taiwan and China. So some of the supply constraints getting weakened in terms of the chip shortages should ease supply in the electronics and automobile segments. That's point one. Point two is obviously that everybody is hoping that the COVID waves will now not affect the economy as much as they have done in the last 2 years. And if that happens, there would obviously be a recovery in the contact services, again, which is something very important also for the mall sector. And again, third point, I already mentioned that the demand is already picking up slowly. So there should definitely be at least some pickup in terms of demand. On the risk factors, which one needs to consider, one is that can there be a lingering impact of COVID shocks on household incomes for, again, the low-income households and rural households? That's the first concern. Second concern is the global inflation, which is there. Now, and we have some more discussion I have on the next couple of slides, but the basic idea is that because there's a inflationary scenario in the global market for almost all the commodities, what we have seen in India at the moment is that for the commodity prices that have increased very significantly, but consumer prices as yet, the companies have not been able to pass on that much. So at the moment, the companies are taking more of a hit But that's primarily because the demand has been relatively weak. Now, if the demand recovers, the other concern is that if the inflationary concerns are still there, companies start passing on this price cost that they are facing onto the consumer price also. And if that happens, obviously there might be a consumer confidence challenge. And the third risk is that for the consumer durable sector, at least, the rise in interest rates may again affect the demand for the consumers, because at the moment the interest rates are low, but there might be a situation because of inflation that interest rates may rise. So that's broadly the story that is there on the consumption side. Next slide, please. Yeah, a very quick point on the growth part. Everything is not, it's not as if the budget didn't have anything for the demand at all. One key point is that the capital investment that the government has promised, that has increased significantly. So from the economic perspective, when that happens, there is a multiplier effect of the capital investments on other sectors of the economy, and eventually it starts trickling down to the consumer also. So the consumer demand also picks up. So certainly this boost that the budget has given on the capex side, it may take a while, but that it will trickle down certainly to the consumption side also. So that's something that is definitely a positive to look forward to. Next slide, please. Yes, so the final point I wanted to make is on the inflation and the interest rate side. And that is a concern that will be there for the consumer, certainly. At the moment, what we have seen is that because the demand is still not that high, but the inflation is happening because of global factors. And one of them is, for example, the energy markets, because the Brent crude, for example, is at close to $90 per barrel. And because of that, the cost of oil marketing companies has increased, and therefore that has been passed on in terms of higher petrol and diesel cost. So at the moment, it seems to be the case that this will persist. And if it does, then certainly the oil, petrol prices and the diesel prices in India will also remain relatively high. The other challenge is that for a lot of other commodities globally, there's a lot of speculation that has started to happen. And that has also started causing, that has also led to price remaining high. So given all these situations, RBI at the moment has not increased interest rates, but RBI may start to increase interest rates in the coming months. In fact, there will definitely be some increase in the interest rates from the RBI side, because the US is also going to start increasing the interest rates, which again translates to the fact that banks will also start increasing the interest rates for loans, and consumer durable sector will have to consider that impact also. Again, from the government side, what they are hoping is that all of this remains orderly. It doesn't happen in a sudden way. So the only thing we have to watch out for is that globally there should not be too many shocks going forward, both in the Middle East as well as, for example, now there are geopolitical concerns going on. So if that happens, there will be some ripple effect onto the everyday consumer in a household also. Yeah, I think that's it from my side. I'll be happy to take questions at the end of the session. Thank you.
Thank you very much, Chinmaya, for your valuable inputs on the economy part. I'm now requesting Rahul to take up the direct tax proposals announced in the budget. Yeah, Rahul, over to you.
Thanks, and Sanket, and thanks, Chinmaya, for the wonderful insights on the economy. And good evening, everyone. So Sanket, can you move on? So as indicated by Gautamji earlier on, that from a tax rate standpoint, the expectation of the sector as well as all individuals was, certain tweaks in the tax rates or the standard deductions, probably, which would have helped to increase the disposable income in the hands of individuals, which will help the sector at lot. Unfortunately, the tax rates remain constant, no change in the standard deduction or probably deduction for interest for housing loans. A minor tweak probably they've done for individuals is on the surcharge applicable to the long-term capital gains on transfer of certain type of assets, namely property and unlisted shares of private company. The surcharge was as high as peak of 37% or 25% typically applicable to HNIs and ultra HNIs. So the resulting long-term capital gains has now reduced from 28.5% to 24% odd. So that's probably the only tweak when it comes to the tax rates. There were certain COVID-related measures which the government has brought into the act. They had brought in a press note or press release in the month of June, talking about the relief that was given to people who are receiving benefits or extra support from their employers or third parties for COVID health-related expenditure, or probably monies or sums received on a death in the family on account of COVID. So the first change was brought about that any expenditure done by the employer for the employee for self or for their family purpose would not be regarded as a perquisite under Section 17, that is for salary. And also a similar exemption was granted under the gift tax laws as well. Separately, they also brought in an exemption if a company employer extends to provide any support on death of their employees on account of COVID. So any sum received by the family is exempt without any limits. They also have brought in certain reliefs for the family members if they receive any further extension or support from third parties other than the employer. However, there is a cap of rupees 10 lakhs which is brought in. The rider out here is that the benefit or the sum needs to be received within 12 months from the death of the relevant person. So I think this is what they've just formalized the press statement which they brought in June last year. Sanket, can we move on, please?
Yeah, Rahul, there is some technical glitch on the screen, some yellow line appearing. So give me a moment. I'm resharing my screen. Just give me a moment. I'll just do it. Yeah, I'm just going to the next. Yeah, please continue.
So as we are aware that the government had introduced a concessional tax rate of 15% for a new domestic manufacturing couple of years ago. The rider was then that the new facility should have started to commence manufacturing or production on or before 31st March 2023. To boost Make in India and manufacturing in India, the government has further extended the sunset clause to 31st March 2024. So this is a welcome move. It will only encourage people and entrepreneurs to set up manufacturing in India. Also, with this whole startup environment in India, currently you're seeing many a benefit which was available. Profit-linked exemptions were eligible for startups for a period of 3 years out of a period of 10 years that they could choose. The benefit was available for startups who were incorporated between 1st April 2016 and 1st of April 2022. The FM in a speech announced that on account of COVID, there have been delays in setting up of such startups, and accordingly to support such startups, the sunset clause has been extended by a year to 31st March 2023. So again, a welcome move, and it will surely help the young entrepreneurs and people who want to set up their own startups and ecosystems. Sanket, can we move? As part of this budget, what the FM has also done is probably, kind of overturned quite a few judgments of High Court or Supreme Court. And this is another change pertaining to that. The existing law, and there was controversy whether exempt income pertaining to expenses or pertaining to exempt income, whether the same needs to be allowed, disallowed, if in a scenario where in a particular year the company has not earned any income. It has now been clarified that the Section 14A provisions will apply irrespective of whether the exempt income is earned by the company or not, thereby making the whole controversy, putting an end to the controversy and overruling various judgments. So this is very clear and amplified by the FM through this amendment in the budget. Also, there were certain clarifications on allowability of expenditure under 37. an amendment was made to say that that if any expenditure is incurred for the purpose which is an offense or which is prohibited under a law, shall not be deemed to be incurred for the purpose of business and should be disallowed at the time of computing the income. So accordingly, any expenditure, particularly this was brought in for and relevant more for various payments which are made by the pharma sector, typically to doctors, etc. That was the genesis that was given in the memorandum. But the point to be noted out here is that any expenditure which is a law offense under any other act or law in India would be disallowed at the time of computing your income. Also, opposition and a contrary amendment was brought in link to this change was that introduction of TDS provisions on the benefit or perquisite arising from business or profession. So the current law already talks about that under section 28, that in any business or profession who earns any or gets any benefit or perquisite from a third party needs to declare and offer it to tax in their own returns. Unfortunately, the government said that currently the same is not happening, and accordingly, to widen the tax base and ensure that people comply with the provisions, they have put this condition and made it onerous for the payer to ensure that whenever they are extending such benefits to a recipient, TDS needs to be deducted at 10% on the value of such benefit or perquisite on sums exceeding 20,000 rupees during a particular financial year per recipient. There are certain exemptions which are being given to individuals and HUF carrying on business and profession with thresholds of 50 lakhs and 1 crore of turnover. So it should not apply if their turnovers don't exceed that limits. The relevance probably for the sector is that if probably any benefit, and question is that if any benefits are passed on to our dealers or distributors, whether for conferences or whether for achieving certain targets, etc., if any benefit is being rolled and passed on or any gifts are being given, whether those would be attracted for TDS under this said new law. Obviously, there are a lot of things which are unclear how, in terms of valuation, how does one value the benefit, what is perquisite. So, things will evolve as we move along, but this could be one of the relevant changes which could impact the sector. Sanket, can we move? This is another change wherein by the government, the FM in our budget speech has overturned another High Court ruling of Cessa Goa, wherein companies and assessees were claiming the education cess part of the oral tax liability as a tax deduction. However, in her speech, she said the intent was very clear, and this is to note that this is a retroactive amendment right from 2005-06 assessment year, and the change which is proposed clearly states that it is to clarify that the tax always intended to include surcharge and cess, and it is not the cess component is not allowed as a deductible expenditure. Accordingly, any the assessees who have made these claims in the past would have to revisit and ensure that proper disclosures and whether proper tax liabilities along with interest would have to be now paid to ensure that we stop the interest outflow on us. Sanket, can we move on? With regards to withholding tax related provisions, the government introduced the TDS and TCS last year with certain riders to say that on certain specified persons, a higher rate of TDS or TCS at the rate of 5% would be applicable. They had defined what a specified person means, and it was typically included someone who has not filed their returns for the last 2 years. The same has been now amended to say that a specified person will only include someone who has not filed their return in the previous year. So probably they've reduced the whole definition from the last 2 years to 1 year. And this is effective from 1st April 21. So it will have implications in the current year as well. Changes pertaining to compliance and assessment related changes. As we are aware that currently the law enables all SSEs and tax filers to file either a belated return or a revised return, and the opportunity is given to all. The time frame is up to 3 months prior to the end of the assessment year. One can file a belated return or a revised return. The law has now brought in to say that one as an assessee has an opportunity to file an updated return in a scenario where they or he or she has forgotten to disclose, or probably in a scenario not probably compute or pay the appropriate tax. Then within a time frame of 2 years from the end of the assessment year, one can file an updated tax return with the authorities. So the provision has been, and the facility has been brought in. There are certain riders which were introduced and that are applicable. So one cannot file an updated return in case if the original return was a lost return, or there is a decrease in the overall tax liability or increase in the refund post you file your updated returns. We may not be able to file a return in case there is a matter of search or seizure, or there is some additional findings for a taxpayer through some exchange of information or such other proceedings. Updated return also cannot be filed in a scenario where an assessment proceeding has already been initiated in the taxpayer's case. So there are certain few riders obviously which has been brought in. What has also been spoken about is that for one to file and go down this updated return route, you need to pay an additional tax to the extent of 25% of the total tax and interest which would be payable if the updated return is filed within 1 year from the end of the assessment year. So in a scenario where you're out, ideally including tax and interest would have been 100. In the revised scenario, you would have had to pay 125. And if you propose to file the updated return post 1 year, but prior to 2 years, in the said example, you'll have to pay 150 because it talks about paying 50% additionally. Reducing multiplicity of appeals before High Court and Tribunal, given that the huge backlog which is pending before the High Courts and the tribunals, the government has brought in that in case an tribunal ruling is in favor of probably the assessee, or there is a pending on the similar grounds of favorable order of the High Court or Supreme Court. In such a scenario, the department will not file an appeal before the tribunal or the High Courts or Supreme Courts, and to ensure that we don't lead to unnecessary filings of litigations and bombarding the High Courts with various appeals. So that's a welcome move as such to avoid litigation across various years. Certain administrative difficulties were brought in and were there typically in a business reorganization scenario. As we are aware that in a merger demerger scenario, typically the court schemes do take a lot of time, and at times we've seen that the courts take more than probably 12 to 18 months to pass an order giving effect to a scheme. In the interim, what happens is that there are various notices and orders which were typically issued by the tax authorities on the predecessor company. And by the time the proceedings were getting over, probably the court orders were issued and the predecessor ideally would cease to exist. So there are certain tax payers or companies who used to take an argument that once the company ceases to exist, any notices or orders on them are bad in law, and there are court rulings which have held that have squashed the assessments or the proceedings. So to ensure that such rulings are overturned, they have ensured that amendment has brought in to say that the successor, the proceedings will be equally lie on the successor, and the order is also good on the successor. So whether the proceedings are either on the predecessor or successor, they will be good. They will be good in law, and it cannot get squashed. Also, currently we have seen that given that there has been delays in terms of getting court orders, at times the revised filing of the revised tax return timelines have gone away with. and the successor at times doesn't get the opportunity to file a revised return or modified return post merger or demerger. So now an opportunity has been given by the authorities to the successor to file a revised or a modified return within 6 months from the end of the month in which the reorganization order has been pronounced by the NCLT or the High Court, as the case may be. Revision for transfer pricing orders, provision of section 236 to 263 have been amended specifically to include revision of transfer pricing orders as well. The provision was silent and did not allow this to happen earlier. It has been amended now to include this as well. Moving on, please. The scope of reassessment has been extended now. Earlier we required, the assessing officer required multiple level of approvals at various stages to undertake a reassessment. However, that is now done away with, and a single approval is only required for an officer to reinitiate a reassessment. And the scope is also being expanded, and an assessing officer can now reinitiate reassessment even if there is an audit objection has been received internally by them, or basis certain information or international exchange received by him under international exchange or information agreements. Or the last point is quite broad enough to say if there is a unfavorable order by a court or a tribunal, then also there is a possibility now that the assessing officer can go back and reopen cases as well. So this is quite broad and could have certain ramifications for the taxpayer. The time frame currently for reassessment is 3 years, and it could go beyond to 10 years in certain scenarios. That also has been relaxed, and the scope has now been quite broadened to say that where the investment in assets, expenditure, occasion or event is more than 50 lakhs in a particular year or over a period of 3 or multiple years, then also the assessing officer has an opportunity to reinitiate reassessment as well. Moving on. So Paresh, I'll conclude in 2 minutes. We have only a few slides to go. Yeah. Process for faceless assessment, which was brought in a couple of years back, has just been streamlined. Quickly run through it in terms of the major points is that a specific provision has been granted for personal hearing for all taxpayers upon request. Such hearings would now only be through video conferencing. NFEC is only to act as a point of contact between various units under the scheme, and it is not more responsible to carry out any functions such as processing of draft orders, so on and so forth. Regional faceless assessment centers have now been demolished, and NFAC will be directly responsible to coordinate internally as well. Moving on. This was much awaited and spoken about in terms of the crypto tax or the taxation of virtual digital assets. Virtual digital assets means any code or number token generated through crypto or otherwise NFT or any other token of similar nature. A flat tax rate of 30% has been introduced plus surcharge and cess as applicable. No cost of acquisition would be allowed as a deduction, and no other related cost would be allowed as a deduction. Loss on transfer of such virtual digital assets will not be allowed to be carried forward or set off as such against any other income. The provisions have been brought in effective 1st April 2022. Current year, you may tax crypto as business income or capital gains as the case may be. Gift on virtual digital assets would be taxable in the hands of the recipient. One could explore gifting of virtual assets amongst relatives and seek exemptions as currently provided for any gift between relatives as defined under the Act. TDS has been introduced at the rate of 1% on such digital virtual transactions effective 1st July 2022. Lastly, couple of changes around concessional tax rates on dividend earned by Indian company from its foreign companies. Since last year, DDT was abolished and Indian companies are now taxed on their income earned by from other Indian companies at normal tax rates. to bring in line with the said tax rates. The 15% concessional tax rate is done away with. And now any income which an ICO earns from its foreign subsidiaries would be taxed at par with local rates. Unexplained cash credits. Earlier, the companies receiving large sums of investments either at the time of share application or through share premiums or share issues were only questioned by the assessing officers. However, now the definition has been widened to include loans and borrowings as well. So it's quite onerous, and the responsibility is now on the taxpayer to prove the source of the funds for taking such borrowings as well. Lastly, few changes in terms of relaxations provided to genuine hardships in delay in filing of returns. The delay of penalty would not be levied if genuine hardship is proven. And prosecution provisions have been extended to cover cases relating to failure of payment of TCS as well. This was not there, but was introduced as well. I'm happy to take questions at the end of the session. Now I'll hand over to Sarika and Sanket to take you all through the indirect tax proposals as well. Thank you.
Thank you very much. Thank you very much.
Thanks, Rahul, and a very good evening to everybody. We'll start with the customs-related budget proposals and then move on to GST. Overall, if you look at the budget proposals from a customs perspective, and this was expected as the government has done in the last budget as well, is pruning of exemptions available to imported products and promoting the whole Make in India and Atmanirbhar Bharat policy of the government. And consequent to that, there have been several duty rate changes that have been made. In total, some 350 exemptions were withdrawn or reduced. Also on the capital goods side, to promote even manufacture of capital goods now, the government plans to phase out concessional rates that are available on capital goods for many industries, including food processing and the leather industry and so on and so forth. And also the project import scheme, which till now allowed companies to import at a reduced rate of customs duty on the capital goods. The changes are proposed to be implemented gradually. To begin with, the moderate tariff of 7.5% has been made applicable. This will kick in from October, and then there will be a gradual increase that will happen. There was also a circular issued more in favor of assessees on the applicability of the social welfare surcharge on goods that were exempted from basic customs duty unconditionally. There were certain cases that were coming up of the assessing officers at the customs port demanding social welfare surcharge even where the basic customs duty was exempted. And the government has now clarified that where the BCD is exempted, there will be no social welfare surcharge payable. So these were, and we look at some of the how the rates have moved on some of the products in the following slides. But before that, also certain changes in the law were made with regard to the customs adjudication and the advanced ruling processes. There were earlier certain rulings, including the landmark judgment being the Supreme Court ruling in the case of Canon India, where the Supreme Court had held that DRI did not have the proper authority to initiate investigations or issue show cause notices, and those limitations to the validity of DRI proceedings and to other investigative wings of the Customs Department, they have been sought to be removed by virtue of the amendments that have been made in the law. And they effectively, nullify the observations of the Supreme Court made in case of Canon India. It's also now put in the law specifically that post completion of any investigation or audit, any further proceedings like the reassessment of imports or the adjudication itself will be exercised by the original jurisdictional authority and not the investigative department. A key change that has been brought in is with regard to advanced rulings, where the law has been amended to provide that an advanced ruling once pronounced will be applicable for 3 years from the date of its pronouncement, or till there is a change in the law or the facts, whichever is earlier. So this is a bit of a blow to the industry, because it takes away the certainty that an advanced ruling would generally brings in, assuming the facts do not change or the law does not change. Irrespective of that, now going forward, an advanced ruling will have validity only for a period of 3 years. And it is also clarified that any advanced rulings that have been issued prior to the Finance Bill 2022, they will remain valid for 3 years from the date of the presidential assent of the Finance Bill. In terms of procedures, a key change made is that goods on which there are certain concessions or exemptions from customs duty, and which are subject to following the IGCR procedure, they have been amended to say that now the IGCR regulations will follow a complete digital process, and all the information that is required to be submitted will be through an online portal. And manual filing of documents or information under these rules will be done away with. Sanket, we can move on. So as you see, there have been rate movements. These are certain reductions in the customs duty rates which have happened, and these are mostly for products which are used for manufacturing or further processing. For example, simply sewn natural diamonds, or camera lenses for mobile phones, or certain parts of transformers for manufacture of chargers, adapters. Cocoa beans, which are whole or broken raw or roasted. There have been certain duty rate decreases for the seafood industry. With respect to the textile and apparel sector, the rate on certain woven fabrics and jackets, blazers, etc., has been marginally reduced from 25% to multiple rates ranging from 10% to 20%, or to a specified rate. These are the downward movements that have happened in the budget, but there are equally, increases that have happened on certain products. These are primarily, if you would see, finished products, or where the government wants to incentivize domestic manufacturing. So these include products like umbrellas, parts of umbrellas, imitation jewelry, certain parts of, wearables, which are smartwatches, on certain hearable devices like Bluetooth speakers, earphones, because the government feels they have been giving enough incentives now through PLI schemes and other incentive schemes to such industries. This should the imports should be slightly disincentivized, and the domestic production should be incentivized, and therefore these duty rate increases have happened. Coming to SEZs, the whole SEZ regulation itself, the government feels that it's sort of outlived its utility, especially on the direct tax front, given that there are no further direct tax incentives for any new SEZs being set up, and that sunset clause has already been reached. It will be replaced by a new legislation, and which will also enable states to become partners in the whole development of these hubs, service hubs or manufacturing hubs promoted or focused on exports. So of course, there's no guidelines as of now on what this new legislation would entail, how much would be the center's contribution or participation, and what percentage would states participate. But clearly exciting times to see and watch out for in terms of what the new legislation would entail, and how that would contribute to creation of new infrastructure, and which in turn will enhance export competitiveness of in India, services and goods exported from India. Also, another change, procedural change that the government has, notified, is that all the customs administration of SEZs will be made completely digital, and it will function on the customs national portal with effect from 30th September. Again, a move, under the whole Digital India campaign that the government wants to focus on. So this is a move towards that. Moving on to the GST proposals, we honestly weren't expecting too many changes to come on the GST front, especially given the notification that had just been made effective from 1st of January. But still, on the GST front, there have been a few surprises that the government has brought in by the budget. Some of them are not very favorable for the industry, unfortunately, and Sanket will talk about them in some more detail in a few minutes. But before that, I want to spend a couple of minutes on the legislative changes that have happened on the compliance side. So now there have been specific amendments proposed, which as per which now 3B return would be one would be able to file only after the GSTR1 has been filed for that particular tax period. Similarly, sequential tax period wise filing of GSTR1 has been made mandatory. So one would not be able to file a GSTR1 for a current period without filing the GSTR1 for all prior periods in sequence. Further, GST registration for anybody could be cancelled now if the returns have not been filed for a continuous period, which will be prescribed by the government. Till now, this prescribed period was 6 months. So the registration could be cancelled only where the returns were not filed continuously for at least 6 months. But now they have removed the 6 months limit, and they have taken the powers to prescribe any period as the government would wish. And we foresee that depending on the compliance levels, government could prescribe a shorter time period as well, where they could invoke cancellation of the registration for certain classes of maybe defaulting taxpayers. Also, the government has introduced powers whereby they could restrict or prescribe, the maximum percentage of the output tax liability which can be discharged through the credit ledger, and the balance would necessarily be required to be discharged through the cash ledger. And there is a late fee that has been announced for delayed filing of GST TCS returns. In terms of certain benefits that the government has announced, there is a time limit extension that has been given from 30th September of the following financial year to now 30th November of the following financial year for issuance of any credit notes pertaining to a financial year or for rectification of any errors or omissions in the outward details that one would submit. So this is, of course, a beneficial and a welcome move. The other proposal is to allow transfer of any balances in the electronic cash ledger within different GSTN registrations of the same entity having the same PAN. So that now if you have balances in any of your electronic cash ledgers in any particular registration, you could transfer it to another GST registration in different state. Of course, the question has been raised by the industry, if you're allowing this for the cash ledger, why not allow this for credit ledger as well? This representation, I think, this point is being raised across different forums. And the CBIC, basis our, interactions with the CBIC in the last couple of days post the budget, they have agreed to, look into this topic as well. And hopefully in the coming times, we may see some provisions allowing transfer of credit across registrations as well. But as of now, this is restricted to only the cash ledger. Sanket, I'll request you to now speak on the ITC related changes. I think this is the biggest one that impacts the whole trade and industry. So over to you, Sanket.
Thank you, Sarika, and thank you for summarizing the budget changes for customs and GST. Once again, a warm good evening to everyone. So basically, the point here is on the input tax credit, and what we have tried to do here on the screen, if you can see, we have tried to summarize the story of input tax credit for GST from day one, that is July 2017, till now, that is Jan 2022. So almost a journey of 4.5 years. if we see, initially there was a provision which allowed us to take input tax credit basis invoice or the tax invoice that we used to receive, and also the goods, physical receipt of goods or the services. And so far as the tax has been paid by the supplier, as per law, we were eligible for claiming credit. The government had thought about bringing in an online matching concept, which is basically an invoice to invoice matching, wherein the vendor or our supplier from whom we are buying uploads data on the government portal, GSTN portal, and then we have to match it with what is appearing in a purchase register. And they had come up with a return called GSTR2, wherein we had to upload that, and on online matching was supposed to happen. However, this GSTR2 was never implemented. It was kept on hold. And then they came up with GSTR3B return, wherein assessee was allowed to take input tax credit based on self-assessment. So whatever we used to declare as eligible input tax credit, companies used to claim. And then subsequently, we may receive notices on matching and all, but not on an invoice to invoice real-time matching. In 2019, more specifically October 2019, for the first time they came up with this point that input tax credit has to be matched at an invoice level with your vendors, and an error or rather a 20% leeway has been given. So for example, you have input tax credit of 100 rupees in your purchase register for a particular month, and let's say out of that 100, 80 is matching with what your vendor has uploaded, which is a 80% match. Then the law allowed you to take 80% plus 20% on, so 96 rupees in short. So 16 rupees was allowed to be taken as a provisional credit, although it is not matching, but balance 80% had to be matched. So this was the first time it was brought in October 19. Subsequently, in Jan 2020, they reduced that 20% to 10%. So gradually they made it 80% plus 10%. In Jan 2021, they further reduced it to 5%. So which means 80 plus 5%, which is 84 rupees. And now in Jan 2022, which is the final step, they have said that input tax credit can only be taken if your vendor has uploaded the details on the government portal, which is nothing but GSTR1 return, which your vendor has to file on a regular basis, either monthly or quarterly, depending on his whether he's a small time dealer or a large company. So now the amendment which has come in the law is that you will not get input tax credit unless your vendor has uploaded the invoice-wise details on the GSTN portal. So that is an important amendment which has happened. So what does it mean? It means that every company will now be mandatorily required to do a proper reconciliation at an invoice level on a monthly basis and take input tax credit only of the invoices which are actually matching with what your vendor has uploaded. And if you take any excess credit, you may receive a notice saying this is excess credit and you will have to reverse it, and there could be interest implications as well. So this is a very important change which has happened. The other, consistent with this important change, there are some other changes also which have happened with respect to input tax credit. So one is that the two-way communication process, which is GSTR2 that we discussed a few minutes back, that has been done away with, because now they have come up with a 100% matching concept, and they have come up with GSTR2B, which is nothing but whatever your vendors have uploaded on a monthly basis, it will come to you as a buyer or a recipient by the 14th of the next month in a form called as GSTR2B. You can view it online, and then you can carry out your reconciliation. If again, reiterating the point that if the supplier has not paid the tax, the recipient will be required to reverse the input tax credit with applicable interest. certain additional restrictions, continued default in payment of tax by the vendor, or if there is a difference between GSTR 1 or 3B, or if there is any breach of the prescribed tax limit paid through electronic credit ledger. In all these situations, there could be restrictions in claiming input tax credit. As Sarika also mentioned, one relaxation which has been announced with respect to input tax credit is that if you are claiming input tax credit for any financial year, earlier the law said that you had to claim it by 30th September of the next year. To illustrate, for the financial year 21-22, which is the current year, you can claim input tax credit by 30th September 2022. However, now they have changed it to 30th November. So you have 2 more months to regularize or to talk to your vendor, get it uploaded, and then you claim input tax credit. Another amendment, or it is more of a clarification, that the interest rate on delay of GST, delayed payment of GST, has always been 18%. However, there was a provision saying 24% interest will apply if you are taking input tax credit which is mismatched or which is not matching with your vendor. But this provision was not applicable because GSTR 2 was always on hold. And that's why the position has always been that it should be 18%. But now they have brought a specific amendment in the law itself to say that the GST interest rate will be 18%. So the 24% penal nature interest has been officially removed from the GST Act now. Okay, so what does it mean? I mean, this monthly reconciliation on GSTR 2B, what is the impact on the industry, or what are the steps to be taken by our sector or by our companies to comply with this? So one is that at the end of every month, we have to see what is appearing on the government portal, which is GSTR 2B, which will be available by 14th of the next month. Second is that we have to also verify whether the invoices that we have received from our vendor, they have a valid QR code or a IRN. So everybody, I mean, you would have seen the e-invoicing regulations which were introduced in October 2020, and initially they covered large companies more than 500 crores turnover. They gradually kept reducing the turnover threshold. Now it is 50 crores. So practically all companies who are more than 50 crores turnover have to issue a e-invoice with a QR code. And if the QR code is not valid, then again, there could be a question on input tax credit eligibility. So that's why the step is to verify whether your vendor has applied the correct QR code on the invoice. Payment to be made to the vendors before confirming compliance or reporting status. So this is one aspect which you can explore, and this could undergo, I mean, your accounts payable process could undergo a change because of this. And companies have started thinking on these lines that if my vendor is not filing the return properly, is not uploading, is not giving me a proper QR code on the invoice, then probably I should hold the payment at least to the extent of the tax. So, and maybe release the principal amount, but the tax amount can be kept on hold till the time my vendor regularizes. This can be, this is very relevant because it results in cash flow saving for the company, which is very much critical in today's time. So that's the point. I mean, this sort of amendment, and there are solutions available, technology solutions, automated solutions, which are available, which help companies to do this reconciliation exercise on an automated basis, even on a daily basis or on a real-time basis is possible, so that the accounts payable team also takes immediate actions in terms of what needs to be done, whether we need to process the invoice. There are also ways of communicating the vendor. I mean, auto emails can be sent to the vendors saying that your invoice is not matching. So all these are steps which can be looked at by companies to secure their input tax credit and also save some cash flow for the company. And by doing this process, our experience says that more and more vendors start doing this on a more diligent and regular basis, and the matching percentage gradually keeps increasing, which in turn helps the overall industry. So the need is to have a robust and automated mechanism for input tax reconciliation as well as vendor communication to secure our input tax credit because of these changes. Okay, so we have covered an important topic with respect to input tax credit. The next topic was, not just look at the budget amendments, but a few amendments which are critical, which took place just about few months before the budget. More specifically, some amendments have been made effective from 1st of January 2022. So it's important to understand those amendments as well. The first amendment which is there is with respect to provisional attachment of property. Now, this is extremely important and critical for business from a business disruption or business functioning perspective, because we have seen that in the VAT regime, and in fact, even there are legacy VAT matters going on even today, wherein companies are facing recovery notices because of non-payment of taxes, and suddenly the tax authorities issue a notice to the bank and freezing your bank account or doing attachment of your bank account, and this may result in critical business disruption. And that's why it's very important to know that even under GST law now, they have empowered the GST authorities to do this provisional attachment of property. And how have they empowered this? Any proceedings, whether it is for regular assessment or inspection or search or seizure or any kind of recovery proceedings, or where they have issued a show cause notice for suppression of any facts, or show cause notice for just mere non-payment of tax or short payment of tax. So in any of these proceedings, which ranges from section 62 to 64 of the GST Act, the authorities now have the powers to do recovery of taxes. So we should be extremely careful about how these proceedings happen, and we should be mindful on what sort of steps can the authorities take. Although there has been a circular by the government which clarifies that these kind of powers of provisional attachment of property should be exercised judiciously with utmost circumspection and maximum care, and they should not just resort to such recovery proceedings in all the cases, or cases where the assessee could be genuine, not doing any evasion of taxes. In those cases, they should not do it. This is a circular issued by the government. However, we should be aware that the GST authorities, could do this in the future, and we should be geared up for such changes. And if any such notice comes, then what could be the recourse? How should we deal with it? What could be alternate resolutions to deal with it? Just to quote an example, this is a very fresh case which came in the Bombay High Court just a few days back, wherein one of the assessees underwent a recovery under the GST Act, and they had recovered the taxes and penalties. And the High Court passed an order saying that they should not have resorted to this recovery, because the assessment was done on best judgment basis, and they did not give adequate opportunity to the assessee or to the taxpayer. And that's why the court gave a very clear judgment that such kind of recovery should be done only in extreme cases where the taxpayer is not cooperating, he is doing evasion of tax, only in those cases. So if you face any such proceedings or notices, just wanted to highlight that there are judgments to support you. There are instances, and we should be aware. We could look at what are the open notices. What sort of bank account details have we shared with the GST department? So all these aspects will come into play. The other important amendment which took place is with respect to detention, seizure, and release of goods which are in transit. So one is, I mean, when we move the goods from one location to another, we are aware that we have to generate a document called as a e-way bill. And there have been many instances where e-way bill has either expired or it's not proper, not matching with the actual goods. In those cases, the GST authorities have resorted to detention or seizure, and they insist that you have to pay the tax and penalty, and only then the goods will be released. So they have further amended these provisions. In fact, in certain cases, the penalty which is applicable in such detention or seizure cases, the penalty has been increased. Secondly, the time limit for confiscation. So there is another section which relates to confiscation of goods or conveyances. This section 130 may not be specifically for in transit. It is for any situation. It could be goods lying in a warehouse, goods lying in a factory, or conveyance lying anywhere. They have the powers to do this, and however, section 130 very clearly says that such powers need to be exercised only in case of tax evasion cases. I mean, not in case of regular assessment or some defaults which are inadvertent or not intentional. But we should be aware that the time limit for confiscation of goods, which was earlier 14 days, has been reduced to 7 days. Secondly, if the penalty is not paid within 15 days, the tax authorities have the right to sell the goods or dispose of the goods, or and also do an auction process. If we want to file an appeal against this, we can file an appeal. However, 25% penalty has to be paid as a pre-deposit, even to admit the appeal. But once you once you pay this 25% penalty, then your appeal is, you get an automatic stay, deemed stay on this, and then no further recovery can be done by the authorities. So these are some important points. So the takeaway here is that we should look at opportunities to streamline our logistics process, so as to ensure that we don't land up in such situations where our goods are detained or seized or confiscated. Relook at our arrangements with our transporters. If our transporters are responsible for generating e-way bills for us, then we should put some onus on the transporters, logistics service providers, that it is their responsibility to ensure that the e-way bill is proper and all. Relooking at the terms agreed with your logistics partner is very relevant. And we should also have an action plan in place for release of confiscated or seized goods. So in the event such things happen in future, how do we deal with this situation? We should be prepared, because such kind of situations can come across any time in future for us. Another important recent amendment which took place is with respect to GSTR 1 versus 3B. So the point here is that if the turnover as per GSTR 1, which is your outward supply return, which you file on by 11th of the next month, is more than the turnover that you show in the GSTR 3B return, which you file by 20th of the next month. If the turnover is more, then the authorities could issue a notice, and they may say that you will have to pay the differential tax. And in extreme cases, they may also resort to suspension of your GST registration. So an important takeaway or action point is that when we file our GST returns, we have to ensure that GSTR 1 as well as 3B, the turnover has to match, or if there is a difference, then we should have a proper adequate backup and reasoning for the differences, or reconciliation in place, so that we are consciously aware that if there is a difference, if a notice comes, this is how we reply to those notices. So this was a summary of the recent amendments that have taken place with respect to GST. We also covered the budget amendments with respect to GST and customs. Our last section for today is to discuss some very interesting judgments that have come with respect to GST, and these are applicable for our retail sector, and we should be aware about it. I mean, we have tried to capture some critical judgments or important judgments for your reference. First one is with respect to post-supply discounts. So what happens is that invariably we buy goods from a supplier and then let's say we buy goods at 100 rupees, and then our supplier may be giving us either a cash discount or some kind of an incentive such as volume discount. So for example, if we achieve a certain target or a certain turnover, then our supplier may pass on some volume discount, maybe 2%, 3% of the turnover. And all these incentives or discounts are passed on later, I mean, after we buy the goods. So it's a post-sale or post-supply discount which is passed on. And very commonly, these kind of discounts are passed on through financial credit notes. So without GST basically, because one-to-one linkage with the original invoice may not be possible, and these discounts may not be always agreed in advance, which is required under law. So there were two questions here. One was, let's say I have purchased goods at 100 rupees with 18 rupees GST. And in future, my supplier also gives me a 5 rupee discount. So effectively, my purchase price becomes 95. So the question was that the 18 rupees which I have paid on the original 100 rupees, am I supposed to reverse proportionate credit, which is 5% of 18 rupees? Or am I still eligible for claiming the entire 18 rupees which was charged? And this has gone through multiple litigations. There was a judgment in the case of MRF which was negative. However, the appellate authorities have clarified that this kind of reversal is not required. We also have a new advance ruling now in the case of India Gate Basmati rice, wherein they have said that there is no requirement to reverse input tax credit proportionate in case we get a incentive from the supplier, which is post-supply. The second point which has come out of this judgment is as a recipient or as a buyer, you will receive this incentive from the supplier, which is in the form of cash discount or volume discount, etc. Whether this is liable to GST, so whether this will be treated like your income or supply or some service that you have provided. Now, there has been a negative decision on this point in the case of Santosh Distributors, which was where the supplier really was, the distributor was Santosh Distributors, but the supplier was Castrol, and this was in Kerala. However, recently this decision which has come in Madhya Pradesh, it basically clarifies that no GST is leviable on the receiver on cash discount or incentives that we receive from our supplier for any such incentives for post-supply discount. But now we have contrary decisions. One is Santosh Distributors, which is against us, and one is a positive decision in Madhya Pradesh. So the controversy still continues. However, there are grounds to argue and say that such incentives that we receive should not be liable to GST. But given that there is still a contrary decision, we will face litigation on this issue in the coming time. The second interesting decision which has come is in the case of Satyam Shivam paper. So basically here what happened is that the company wanted to move goods from one location to another, and they had generated an e-way bill for this. However, during this time, there was agitation owing to anti-CAA and anti-NRC, the Constitutional Amendment Act agitation which took place. And because of that, there was a traffic blockage and the vehicles could not move for a few days. And that's why there was a delay in the shipment. And the e-way bill in the meantime got expired. So what the GST authorities did was that they confiscated and detained the goods, and then they insisted that the company should pay tax and penalty, and only then they will release the goods. So the company had to pay in order to continue. Okay, and they paid it, but at the same time they approached the High Court saying that such kind of recovery should not have been done because there was no fault from our side. It was because of the agitation and the strike that took place, there was a delay. So the High Court gave a very clear judgment saying that the state alone remains responsible for not providing smooth passage of traffic. So the state was responsible and it was not a fault of the company. If they want to levy any kind of tax or penalty, then the onus to prove that there was a tax evasion and all is on the department. So the GST department will have to substantiate and prove that there was tax evasion from the company. And if there is no instance of tax evasion and it was only a genuine mistake or a procedural lapse, in those cases, they should not resort to such kind of recovery of tax and penalty. So the point that is coming out is that to levy penalty on e-way bill violations, and this point is very relevant from a supply chain perspective, that if the department tries to levy tax and penalty, now we have a Supreme Court decision. Because this High Court decision has also been upheld by the Supreme Court. The department even went to the Supreme Court against the High Court decision, but the Supreme Court again affirmed the order of the High Court, saying that what the High Court is saying is right. Department has to prove that there was an intention to evade tax. Only then such kind of recovery of tax and penalty is warranted on e-way bill violations. The third important, yes, Sarika.
Sorry, I'm just conscious of the time. Maybe we'll just take this one and then go to Q&A.
Yeah, we'll take this one. This was anyways the penultimate judgment. Here to just in the interest of time, what we wanted to convey was that there are quite a few judgments which have come in now, which are supporting the stand or the position that a company doing employee recoveries, for example, for canteen food or for notice pay or health insurance, telephone charges, or transport, bus transport facility, such kind of recoveries done from the employees, because these are facilities which are provided to the employees who are working in the office or working for the company. There was litigation around this that even such recovery should attract GST. But now there are quite a few judgments to support this fact that there should not be GST applicable on such recoveries, because companies only doing it, providing these facilities on and entering into contracts on behalf of the employees. So as such, they are not providing any independent supply, and it is also in the course of the employment contracts. So these are welcome judgments. These are useful judgments. This will protect us for such kind of notices or any litigations that may come on employee recoveries in future. Yeah, we can move on to question and answers now. I will just, we did receive a few questions earlier, and I will also check the chat box in terms of the questions that have come. Okay, so basically what we are, the questions that have come are, I'll just read them out.
So I think let's take the first one for Chinmay, probably Sanket. And there was one of the pre-questions saying, do you think enough has been done to stimulate consumption amongst the urban poor and for rural consumption?
Right.
Yeah. Do you want to share your thoughts on that?
Yeah. So I think honestly, if one looks at the budget directly, in terms of, one can support the urban poor and generally consumption in two ways. One is through revenue measures, and in the budget, at least it can be primarily in the form of personal tax cut, which as we know that there has not been any big change in that. The other can be on the expenditure side, where through some welfare schemes and support, the government can provide help. There, I think the government has announced a measure in terms of credit guarantees for the MSME sector and the hospitality sector. which to some extent continues the protection that it's just simply the extension of the support that the government has already been providing. Perhaps slightly more money that they have put in. Now the credit guarantee will cover a slightly more bigger value. But in terms of otherwise the welfare schemes, the government has not come out with any new scheme, nor have they increased allocations significantly in any particular scheme, except for Jal Nal scheme, which is the piped water scheme, which again is kind of a long-term infrastructure slash supply kind of measure. So yeah, so in terms of directly, the budget has not provided any support to these sections. I think their hope is that once the COVID wave ebbs and the sort of economy kickstarts, automatically some sort of improvement will happen for all of these sections which are affected currently.
Thanks, Chinmay. Thanks. Rahul, there's a question in the live chat regarding the fate of crypto transaction tax. So, do you have any comments or thoughts on that?
So I think I don't, Sarika, you can read the full question. Sorry, I can't see the question.
Sure. Then the question is if there's any decision on crypto transactions tax anytime soon. I think the capital gains tax has come, but I think used to be the STT, whether something similar on crypto.
I don't think so as of now, because these are all I think in the FM in the speech said India will surely come out with its own digital currency, and RBI will come out with laws and regulations around it soon. So I think till that comes, these are all probably portals which are external, etc. So I don't think so there is any conversation around an STT related charge, currently for crypto, barring this 30% tax and 1% TDS, which has been introduced effective 1st July 22 on such transactions.
Sure, thanks. I think most of the other questions that had come in earlier, we have captured or talked about them, as we went through the session, including, what are the changes in GST in budget, what are the impact of GST amendments on retail apparel, ease of filing GST returns. So I think we spoke in depth about that. The whole process of claiming credits, of course, is becoming more and more cumbersome, and a lot of the onus is being put on taxpayers as recipient of goods and services. So I think we all need to be mindful of the kind of restrictions the government has, putting in time and again to ensure that, we don't end up losing any credits or, attracting any penal actions, including probably suspension of registration if any excess credits are claimed. Yeah, I think those were our questions. So I don't see any more in the chat box. So probably I'll hand back the session now to Palak for any closing remarks. Palak, over to you.
Thank you, EY team. Thank you, everyone. I think most of the queries were addressed. In case the viewers have any other questions, they may write to me at palak@rai.net.in. Once again, I thank everyone for being an amazing audience, and we hope this was an insightful session for you, and EY team has been able to address most of the queries. A heartfelt thanks to the EY team for your valuable insights and for sharing your views and opinions in this webinar. Thank you, everyone. Have a nice day.
Thank you.
Thank you.
Thank you very much. Bye-bye. Have a good evening.